Welcome back everyone, and in this video, we are going over 5 of the top dividend kings on the market right now. Owning these stocks and collecting the dividends is one of the purest forms of passive income, and these are the companies who have been growing their dividend payments for over 50 consecutive years, and are some of the most reliable income producing assets in the entire world. And we are going to take a look at companies from multiple different sectors who have all proven over the past half century that they can survive any recession or depression and continue to reward investors with a consistent and growing cash payment. And before we jump into the first dividend king, I'm going to ask you to please hit that like button and subscribe. I am the Gen Z investor, and every single day we talk about the stock market, going over different stocks you can buy and any major market news. So please hit that like button and subscribe for the daily videos. And today we're going to go over 5 of the top dividend kings you can buy right now. And the first stock that we're going to take a look at is Lowe's, ticker LOW, currently trading for $160 per share, and the company's up by over 33% in the trailing 12 months. And over the long term, this dividend king has seen some excellent share price performance. Over the past 5 years, the company's up 130%, and over the past decade, the share price has climbed over 527% overall. And Lowe's is currently trading at a very nice valuation with a forward PE of 16.5. And the company's current market cap is at just below 119 billion with a current dividend yield of 1.5%. And Lowe's just shared their fourth quarter results, and the company beat on both revenue and earnings expectations. And the company's sales rose 26% year over year, and earnings per share also saw some massive growth, climbing up more than 41% in the latest quarter. So Lowe's reported some very strong results, and as more consumers are spending increased amounts of time at home, they're spending the money at a company like Lowe's to buy the products to improve their everyday living space. And going forward throughout 2021, Lowe's is expected to continue to post some very strong numbers, and they've been upgraded to a buy with price targets set of over $200 per share. And from where they are right now, at around $160, that is a ton of potential short-term gains. And if we take a look at the company's income statement, year over year, total revenue continues to grow with a massive spike throughout 2020. And if we take a look at their net income, over the long term, it is trending upwards in the right direction, which is a very strong sign, and just under $6 billion of total net income in the trailing 12 months. And over the next 5 years in the future, we're predicting close to 14% per year growth, and the stock is currently considered a strong buy from analysts. And right now, the current share price sits well below the 12-month expectation. And if we take a look at their dividend, the current yield of 1.5% only makes up 25% of their total net income. And this very low payout ratio gives investors the confidence that their annual dividend will continue to be paid out and has a lot of room to grow each and every year in the future as well. And the company has been growing that payment at a terrific rate, averaging over 16% per year dividend growth. And their current streak sits at 57 consecutive years. So that's just absolutely incredible. Not only have they paid out a dividend, but they've grown it each and every year for 57 straight years. And after a 57-year streak, they still maintain a very sustainable payout ratio, and they continue to grow that income at a very fast rate year over year. And if we take a look, they have a very safe dividend coming in at a 93. So very unlikely that we see a dividend cut coming from Lowe's anytime soon. And I'm sure we will see this dividend streak continue for many, many years in the future. So definitely an interesting company to take a look at right now. With consumers spending more time at home, spending more money improving their home living spaces, this is definitely a name brand and a dividend king that may be worth an add to your current portfolio. And now if we move on to stock number 2, we're going to take a look at ticker J&J, which is Johnson & Johnson. They currently trade for around $158, and over the past year, the company is up just over 12%. And they are one of the largest healthcare companies in the world, with a current market cap of over 427 billion. And they also trade at a very nice valuation with a forward PE just above 17 and a current dividend yield at 2.48%. And Johnson & Johnson is the company that owns some of the most recognizable brands in the consumer healthcare space, such as Tylenol, Listerine, Band-Aid, Aveeno, and many more. And overall, the company has 28 different platforms and products that generate over $1 billion in annual sales. That's just incredible. Overall, the company generated over $80 billion in 2020, and 28 different products, each alone generated over $1 billion, which is extremely impressive and just shows how well diversified Johnson & Johnson really is in the worldwide healthcare space. And if we take a look, the company also returns a ton of capital to investors. Throughout 2020, they returned over $10 billion in the form of annual dividends, and the company also spent more than $12 billion in research and development. And if we take a look at Johnson & Johnson's guidance for the 2021 fiscal year, we can see that they're projecting sales growth of over 9%, and earnings per share are expected to grow by over 17% in the next fiscal year. So that would just be incredible. For the largest healthcare company in the world to post some massive results, I think it can drive the share price much higher than where it is today. And this Dividend King has a current yield of 2.5% with a payout ratio of 42% of their net income. And their annual dividend growth rate is above 6% with a 58-year streak of growing that annual payment to investors. And even after this long history, they still maintain the highest dividend safety score possible, coming in at the 99, which is extremely impressive in itself. So that just shows this healthcare leader has no expectation whatsoever to cut that dividend payment over the next 3 to 5 years in the future. And going forward, just with the products that J&J provides to the market, they will always be in demand, and I see no signs of this healthcare giant slowing down anytime soon. So if you want exposure to the healthcare space and you want to pick the market leader, definitely do some research into J&J at this current level. And now if we transition into the third Dividend King in this video, we're going to take a look at Target, ticker TGT, one of the most beloved retailers by consumers. They currently trade for $183 per share. And over the past year, the share price has seen some terrific growth, and it is up over 65%. They have a forward PE just above 20 with a current market cap of $93 billion. And their current dividend yield is at 1.5% overall. And Target just shared their latest earnings, and they posted some very strong results with quarterly sales growing more than 20%, which is absolutely incredible. And their online and digital sales grew 155%, which is absolutely insane for this traditional retailer. And Target just announced that within many of their stores all across the country, they're going to create a mini Apple shop. And I think this is a great addition to the already beloved Target ecosystem. Adding Apple, the strongest consumer brand on the planet, into your stores in a more proficient way, I think is only going to drive consumer traffic, making Target a more well-known and well-established brand in the traditional retail space. And now if we take a look at Target's income statement, over the long term, total revenue is trending in the right direction. But in the trailing 12 months, we have seen some mass expansion, and it is up over $10 billion. And if we take a look at their bottom line, their total net income has also seen a nice rise as well in the past year. And going forward, over the next 5 years in the future, we're expecting close to 13 to 14% per year growth on this company, and they are currently rated as a buy. And their share price of $183 sits below the 12-month expectation of over $200 per share. And their current dividend of 1.5% again has a very sustainable and low payout ratio below 30% of that net income number, and they're growing it above 4% per year. So not the best dividend growth, but you are outpacing inflation over the long term. And their current dividend growth streak is at 52 consecutive years. And the company's dividend safety score comes in at a 90, so it is a very safe holding for your portfolio and no cuts to that income coming anytime soon. So definitely take a look at Target. In the traditional retail space, a lot of companies are dying away, but Target seems to actually be growing up. They're expanding their product line, they're making their stores more accessible and more attractive, and I think this is a brand that consumers love and will continue to be around for many decades in the future. And now if we move on to Dividend King number 4, we're going to take a look at Procter Gamble. Ticker PG, currently trading for $123 per share, and over the past 12 months, the company is only up a slight 4%. They are one of the largest consumer brands in the world with a market cap of $314 billion and a current dividend yield at 2.5%. And overall, I'm a huge bull on Procter Gamble. If we take a look at their 6-month chart, they are actually on a massive decline, and I believe the share price is at a very attractive level. They're on a close to 15% drop from their 52-week high. And this is a company that is globally diversified and sells pure necessities. And no matter what's going on in the economy, people are still going to have needs that they have to fulfill, and they have to buy products from stores, and Procter & Gamble is a go-to name. And taking a look at their latest investor report, we can see that PG operates in 10 main business segments, and they include personal health care, oral care, home care, fabric care, as well as skin and personal care, health care, grooming, family care, feminine care, and of course, baby care. So like we can see here, everything in every one of their 10 business segments is a necessity. People are always going to need baby care products, feminine care, family care. It doesn't matter if the stock market's going up or down, people are still going to have these demands. And that is why I love owning PG stock, because no matter what, this is a brand that is globally diversified. They own dozens of market-leading brands, including Pampers, Bounty, Gillette, and many more. And taking a look, the company's net sales are also very diversified across many of their business segments. And the top 2 categories, making up 33% of the revenue, is fabric and home care. And what's also very strong about PG is that they operate all across the world, and only 47% of their revenue is coming from North America. So they're not solely reliant on the United States for a majority of their sales. If we see, Europe makes up 22%, Asia Pacific makes up 10%, China makes up 9%, and a couple other areas of the world make up the remaining difference. So overall, they're not reliant on one single market to drive their business forward. And over the next 5 years in the future, analysts are predicting close to 9% annual growth, and the company is currently considered a buy. With a share price of $123, it does sit well below the 12-month price target of $150 overall. And something with Procter & Gamble that I like is their extremely long dividend history. Their current yield of 2.5% only makes up 55% of their total net income. They only have a slight dividend growth rate of 3.5% per year, but they have been growing it for 64 consecutive years, which is absolutely incredible. And even after this long dividend history, the company still maintains the highest dividend safety score possible, coming in at a 99. So not any risk whatsoever of seeing a dividend cut from Procter & Gamble anytime soon. And because 2020 was the year of loading up on consumer goods, Procter & Gamble saw a great bump in their annual revenue. And going forward into 2021, the company actually raised their future guidance by a couple basis points. That's extremely impressive. Right now, not many companies are giving full year guidance because of the uncertainty regarding the pandemic. But Procter & Gamble did the opposite. Not only did they provide guidance, but they increased it from their previous expectations, showing how strong this globally diversified brand really is. And I think the fact that we're seeing a 15% decline in share price makes this company even more attractive right now at this $124 level. So definitely take a look at PG, a top company in the market worth over $300 billion that I truly believe is going to be around for decades, and maybe one of the companies over the next 36 years to actually achieve a 100-year consecutive dividend growth streak. I think that's very optimistic to say, but overall, I'm a long-term PG investor, and I hope the company can achieve that impressive feat over the next few decades. And now finally, if we jump into the last company we're going to take a look at today, we have ticker MMM, or 3M Company. They currently trade for $175 per share, and they operate within the industrial sector. And over the past 12 months, the company has grown by over 21% overall, and their current market cap comes in just above $100 billion. And they're trading with a forward PE of 18.6 and a nice average dividend yield of 3.3%, which is very nice in the very overpriced market that we have right now. And if we take a look at their latest investor presentation, the fourth quarter of 2020, they ended the year very strong. And overall, sales were up 6%, and the company generated over $2.1 billion of cash flow, which was up 16% year over year. And they did a great job of reducing their debt by 9% in the latest quarter. And if we take a look for 2021, the company is expected between 3 and 6% annual sales growth, with earnings per share growing between $9.20 to $9.70 overall. And one thing I like about 3M is they bring in a ton of cash flow, and they're projecting 95 to 105% free cash flow conversion over the full year of 2021. So I think the sales growth of 5 to 8%, they're doing a great job with their capital allocation, and the free cash flow generation makes this a very interesting industrial name to own in your portfolio going forward. And over the next few years, they're only expected to grow at 7% per year, but if you add in that over 3% dividend, it may provide investors with a nice double-digit return. And right now, analysts actually have 3M as a hold, but I do not agree with this recommendation. I actually believe they're in more of a buy level at this current share price, and I think they can still consistently grow over the long term. And taking a look, they have a current dividend yield at that 3.31%. Their payout ratio is only 62% of their net income, and they do a very nice job of growing that dividend, averaging over 7% per year. And their current dividend growth streak comes in at 62 consecutive years, which once again, like all 5 companies that we've discussed today, is extremely impressive. And they also still have a safe dividend coming in at a 75. So overall, 3M is definitely an interesting company, one of the top industrial names on the market right now. And if you want some more diversity and you want to get access to different sectors in the market that really aren't the main tech, consumer, or healthcare brands, definitely take a look at 3M, a strong dividend king, proven to be reliant and successful in every recession and depression, and maybe an interesting addition to your dividend stock portfolio, and they absolutely provide investors with some great passive income. So thank you for watching, everyone. Those were 5 of the top dividend kings on the market right now. We went over a couple different names from various sectors and took a look at companies like Lowe's, Johnson & Johnson, Procter Gamble, Target, and of course 3M at the very end. I love Dividend Kings. I think their companies are extremely impressive, and overall, the fact that all 5 of these stocks still have been growing their dividends for 50 plus consecutive years, and they are all still able to manage their income properly, and they still have very successful and very manageable payout ratios with safe dividends going forward. I just think that just shows how strong these companies are, how resilient they are to economic conditions, and how strong the management is to not only continue to grow year over year, but maintain a strong financial position and continue to return capital to investors in the form of that growing dividend. So I love these companies. I love the passive income they provide, and they're actually one of the strongest income producing assets in the entire world. So thank you for watching, everyone. I am the Gen Z Investor. Please hit that like button and subscribe, and I will see you in tomorrow's video.